Welcome to Phil's Gang video. I'm going to show you what happened on Friday and explain to you, going back to our August sell-off, and compare the two between the August and, of course, this latest sell-off, especially January. Let's go back to August. In August, or before August, in May, okay, going back this way, May, I predicted that we were going to have a sell-off, that we were going to have a crash. And I said May 29th was the date that I said it was the date that I'm going to put down was the beginning of the financial crash. And of course, I didn't say, I said again in June, the same, or July, the same thing. And because I saw a lot of money coming out of the market in July, you can see here it was all red. Okay. And then, of course, August is when we had the big 3-day drop, the 1,900-point drop. Okay. But what was interesting, we had a 12% rally back to the top up here. So which means that we should probably get a 12% rally. Here's our 12% up to here. We should get a 12% rally going back up here, right? Makes sense. But what's going on is different. Well, let's talk about the difference between the August crash and this crash here going to January. The difference is, in this crash, it was easy to get what we call a V-shaped recovery. Let me switch to a line chart, show you. There. These are called V-shaped recoveries right here. Now you notice we went up 6% pretty fast. And then we had some sideways action, and then they test the low again to create a double bottom. And then we started our 12% rally. Well, let's compare over here. We had our drop, but the V-shape right here, the V-shape was only about, well, a little less than 4%, and compared to this guy here that was 6%. So that's different. So we haven't gone down and tested, we haven't made a double bottom yet down here, okay? We'll see if we do. But how are we going to get to the 12%? That's the problem. Why? On this rally up here, it has stuff going for it. It had a lot of good stuff going for it. First of all, number one is they still had the hedge funds, okay, still had hedge funds. They were still borrowing heavily money at 0%, so they could speculate with stocks. You also had at that time, you had companies doing stock buybacks. So you had stock buybacks and you had hedge funds. So that is what drove up that 12% from this point right here up to here, that 12%. And because you have hedge funds and stock buybacks. Also, over here, that you had, remember that 0% interest rate going on over here? Okay, zero interest. All right. Now, let's compare what do we got going for us over here. Do we still have hedge funds? No. Over here, hedge funds? No, that's gone. Hedge funds are gone. So we don't get that on this side here, so that's gone. How about stock buybacks? No. No more stock buybacks either. Okay, you're not getting stock buybacks. One, it's earnings season. So that's gone. Zero interest? No. This time we got a hike. Okay, so we got a hike this time. All right, got a hike, rate hike, okay, over here. So now we got a rate hike. We didn't have before, but we got something else over here. Okay, so we're not going to have hedge funds helping us. We're not going to have stock buyback, and we're not going to have zero money. We're going to have a quarter interest rate hike, and we have three times the amount of sellers, people who are short. Okay, and that's why you got this tremendous pressure that you didn't have over here. That's why you got this thing to go up. Because over here, you got all of this stuff right here. You got all this. You got the all kinds of shorts, three times the amount of shorts you had over here. And that's putting pressure right on this market, okay? And you have hedge fund. You don't have the hedge funds helping you either over here. So there's not much to push us up through here. Now, we also got another problem. We had on this side that we didn't have over here, we had our, from end of 2014 from 2014, okay, 2014 to 2015, okay, we now, which we didn't have on this side over here, we have our numbers in, and it showed us that our economic growth was really bad, 1.8%. All right, it's supposed to be 2.5. Then we also got some more bad news on this side here that's putting more pressure on us, is because we're finding now the economic growth for the last quarter came in at was 7/10. Now it's 5/10. Okay, really bad. So you got bad earnings, really bad earnings. Okay, and so you got little hope for that same repeat, that 12% short covering rally. It's going to be really tough. So the desperation was they had to get this to move up right here, right there. This was Friday, so let's put it right here. This was Friday, right here. This was Friday. I'll put a candlestick for Friday. So what they did is, so here's what they did. Aunt B, desperate, had to get a rally. They got to move this guy up like this. They need to move this up. So she didn't know what to do. She was beside herself because she had all the bad earnings coming in. She didn't have the hedge fund money, the stock buyback money. We got many more short sellers, so she had to do something. Well, here's what she knew. She knew at the end of the month, right? She knew at the end of the month she had what they call painting the tape, okay? All right, painting the tape was coming in. What's that mean, painting the tape? At the end of each month, they have window dressing, okay? Window dressing. What does that mean? You take JP Morgan, Goldman Sachs, the big brokerage houses, they'll take popular stocks that's in everybody's 401k like Apple, and they'll all get together, JP Morgan, Goldman Sachs, Morgan Stanley, and say, let's all buy 1 million shares each to push the price up. And that way, and this always happens at the end of the month. So they had a perfect setup right here because it was the end of the month. It was the last day of the month right here. Perfect to do that with. But they really wanted to juice it up big time. They wanted to get up 400 points. So how did they do that? They said, well, look. So Aunt B goes to the ECB, European Central Bank, okay, and she talks to Draghi, and Draghi, who already has a negative interest rate policy. Last summer, he put it in place, and also Denmark and Sweden, they put theirs in 2014. So Aunt B said to Draghi, help me convince Japan to put in their policy of negative rates the last day of the month, which was easy to do because Japan, they had a real problem with their. Let me get this. Japan. They had a real problem with their economic growth. Their economic growth came in terrible, 1.9%. And what was falling off the cliff was their sales and capital goods was falling off. So they had capital goods. Was really bad. Their capital goods sales were dropping big time, and that means recession. So it was really easy to talk Japan into doing a negative interest rate, okay? And they did, and that's what gave us that big 400-point rally right there, that big 400-point rally. But when you get a rally like that, how do you know it's going to continue? It's called the key reversal. It means you got to have the very next day a follow through like this. And the volume has to be greater than this day. And then on the third day, this is the key day, the third day, your volume again, you have another follow through, 3-day rally, which the volume is even greater than the previous 2 days. That is called a confirmation. And that means this red line will cross up through the yellow line, which gives you that confirmation that you have a new trend starting. Well, we don't have it, see? We didn't get it. Today was a bad day. So today was a very bad day. And you can see we started out this morning. And when we started out this morning, we were negative 150 points. Then they tried to run it up to get positive today, and they couldn't do it. So it went back negative at the close. So here we stand. Are we going to be able to get to that 12%? Well, I gave you all the reasons why. It's going to be a lot harder than over here. It was easy over here. It's going to be really much tougher. So we'll make money on the way up. And here's the last thing. What we have to watch for is this in a market. A stock market, when it goes up, what you're looking for, if you're going to change and it's going to go up and we're going to have a bull market rally, you want to make sure you're getting buyers on the pullback. So she's starting to pull back right now. And the next 2 days is going to be important. See if we get buyers. And then it pulls back again, and then you get buyers. If that happens, we'll go right up, we'll get that 12%. That's called, okay, buying on the pullback, which means very positive. The institutions will come in and buy if they think going forward the economy is getting better. If not, then it goes this way. Instead of going up, it'll come down, rally back up, make a lower high. That means no one's buying on the pullback. So if no one's buying on the pullback, like right here, no one's buying on the pullback, that's very negative. So we got to see if they're not going to buy on the pullback, or if they are going to buy on the pullback. That's what we got to see in the next 2 days. Then we can make a decision. See over here, it was very clear. Nobody was buying on the pullback. So every time it rallied, it was easy to short and make money, okay? All right. I'll see you on the charts. I hope this helped you understand the difference between the August drop and the drop in January, okay? See you on the charts.